At the moment, I think in this environment it's very important to have a balanced approach within fixed income when we buy both government bonds and credit. In particular, it's important because the government bond component gives stability in your portfolio, particularly in volatile time, while on the other hand you have a corporate bond, particularly high yield, where selectively can still provide a good, attractive income, which is necessary for this low yield environment. For European investors in particular at the moment, focusing more on the euro fixed income rather than global might make sense because the cost of hedging still remains quite high. So for a European investor, buy US dollar bond and hedge into euro represent a big drag in the yield, so losing around 2.8%, 3%. So from that perspective, focusing on euro fixed income might make more sense for European investors in the current environment. The European income portfolio at AB, we've been managing this since 1999, so he has 20 years of track record, so very long experience. It changed over time, so we flexibly invest between, again, government bonds and corporate bonds. And there were times like 2011, 2012 where we were more aggressive or more, let's say, fund credit, more attractive, particularly after the European crisis. Credit spread was dislocated, and given ECB intervention, we find this more attractive. However, times like these, where we expect global growth to slow down, in particular in Europe, we want to be more cautious. So what we did in the portfolio, we increased the duration, so we invest more in a safe government bond like Germany, but at the same time, we invest selectively in credit, focusing more on the higher quality, BBB and BB, because when you look at the other segment of the credit market at the moment, like CCC or single B rated company, yeah, they offer an attractive yield optically, but there is a reason why the yield is so high. So we prefer to be more conservative and create a portfolio with a duration of 5 years around and still some credit risk with a yield of around 2% in euro. As you know, the fixed income market performed extremely well in 2019, and the European income portfolio performed very well as well. However, this is a combination of beta on one end of the market doing well, but at the same time, the active management in the portfolio was definitely positive and created an extra return. I think the four main positions that were contributed positively to the European income portfolio, one was increasing duration at the beginning of the year, that performed very well. The other one, it was focusing more on the higher quality part of the credit market rather than the lower quality, and then when you look in the euro yield market, the higher quality BBB and BB outperform so far the lower quality part of the market. In addition, the position to financials, which still remains one of the strongest conviction, particularly those bonds, subordinated bonds like additional tier 1, they perform extremely well. So here to date, the banking sector returned around 16%. So having this bond in this portfolio was definitely a positive. And the fourth point was investing in, I don't like call it peripheral, I mean I'm Italian, but bonds issued by Italy or Spain actually was good because they perform extremely well alongside the expectation that then they realize that the ECB start again quantitative easing. First of all, we should remind investors that fixed income, investing in fixed income represents the anchor in your portfolio. So it represents capital preservation and income generation. So we should remind them that in a volatile time, particular government bond represents the stability of your portfolio. The second point, I agree that of course there was a big rally in the market so far this year, but so where are we going forward? And the reality is that we continue to see value in fixed income because in this environment, what central banks are doing are keeping rates anchored very low for a long time. And the reason for that is because if we enter into this prolonged low growth environment as we expect, rates that will remain at this level for longer. So as a result, the catalyst for rising rates, which should be the main concern for fixed income investors, remain very low. So if you think about Europe in this low growth, low inflation environment, this is probably the sweet spot for fixed income, because on one end, if you have too much growth, this is bad for fixed income investors because you have rising rates. If you have recession, which we don't expect, is bad for credit. So when you are in this sweet spot of low growth, low inflation, fixed income will do quite well. Another way of framework, it's difficult to have the crystal ball, but if you think about Europe becoming more like Japan in terms of low growth, low inflation, demographics, dynamics, Japan can be a good example of what can happen in the future, because Japan is living this for 10 years. When you look at the Japanese fixed income market, the starting point of the yield has been historically very low, between 0 to 1%. However, the return of the fixed income market was much higher, 2 to 4%. And this is to remind investors that despite the low level yield environment, the expected total return can still be quite attractive. So when you look at a portfolio like European income, in euro, still able to generate around a 3% total return over the market cycle, we think it's quite attractive, particularly when you think that rates in Europe are negative.